What if just 4 ETFs could pay your entire monthly salary forever? Imagine waking up on the first of the month and seeing $3,000 deposited into your account without you having to lift a finger, answer an email, or attend a single soul-crushing meeting. This isn't a pipe dream or some get-rich-quick scheme found in the dark corners of the internet. It is a calculated, math-based approach to building a passive income strategy that actually works. But here is the catch that trips up almost everyone. Most people approach this completely wrong. They either chase yields that are too high and watch their capital vanish, or they play it too safe and never generate enough cash flow to actually quit their jobs. In this video, I am going to show you the exact 4 ETFs that can build this reality, exactly how much money you need to make it happen, and the cold, hard truth about whether this actually works in real-life market conditions. We live in a world where the cost of living is spiraling out of control. Inflation is eating away at your paycheck, job insecurity is at an all-time high, and the traditional 9-to-5 grind is leading to record levels of burnout. You feel it every Sunday night, that weight in your chest, knowing you have to trade another 40 to 60 hours of your life just to keep the lights on. This is where the concept of the lazy person's wealth strategy comes into play. Most people assume that to replace a full-time salary, you need to be a genius stock picker or have tens of millions of dollars sitting in a vault. That is simply not true. While the number you need is still significant, it is much lower than the gatekeepers of Wall Street want you to believe. However, getting there isn't just about saving pennies. It's about shifting your mindset from working for money to making your money work for you. Before we reveal the specific funds, let's break down the core idea. We are talking about exchange-traded funds, or ETFs. Think of an ETF as a basket. Instead of buying one single apple, which might be rotten, you are buying a basket that contains hundreds of different fruits. If one goes bad, the basket stays full. But not all baskets are created equal. To replace a salary, we have to distinguish between income investing and wealth building. Wealth building is about growth, watching a small pile of money turn into a big pile over 30 years. Income investing is about cash flow, the ability of that pile to spit out usable money every single month. To achieve financial independence, we need a hybrid approach. We aren't just looking for stocks that go up, we are looking for an ETF portfolio that pays you consistently, regardless of whether the market is green or red today. We are focusing on funds that prioritize distributions, but keep enough growth potential so you don't run out of money in a decade. Now let's dive into the 4-part architecture of this strategy. We aren't just picking random tickers, we are building a machine with 4 distinct parts. Category 1 is high dividend income. This is the bedrock of your monthly check. Its purpose is consistent, reliable cash flow from established companies. Category 2 is dividend growth. This is vital because a $3,000 salary today won't buy the same amount of groceries in 10 years. You need your raises built in. Category 3 is broad market stability. This reduces your risk and ensures you are capturing the overall growth of the American economy. Finally, Category 4 is the high yield booster. This is the turbocharger that pushes your monthly income higher, though it comes with a bit more complexity. Let's reveal the first piece of the puzzle. SCHD, the Schwab US Dividend Equity ETF. This is the gold standard for dividend growth. SCHD doesn't just look for high yields, it looks for quality. It invests in companies with strong cash flows and a history of increasing their payouts year after year. When you hold SCHD, you are essentially giving yourself an annual raise without asking a boss for permission. The second ETF is JEPI, the JP Morgan Equity Premium Income ETF. This is our primary income generator. GPI uses a clever strategy of holding large cap stocks and selling options against them to generate massive amounts of immediate cash. While a traditional stock might pay you 1 or 2%, JEPI aims for much higher, often landing in the 7 to 10% range. It turns the volatility of the stock market into actual cash in your pocket. The third ETF is VOO, the Vanguard S&P 500 ETF. You might be wondering why a standard growth fund is here. It's because VOO provides the ultimate stability. It tracks the 500 largest companies in the US. While its dividend yield is lower, its capital appreciation ensures your portfolio doesn't just stay flat. It provides the ballast for your ship, making sure that when the storms come, your entire strategy doesn't capsize. The fourth and final ETF is QYLD, the Global X Nasdaq 100 Covered Call ETF. This is the high yield booster, similar to JPY but focused on the tech-heavy Nasdaq. QYLD is designed to pay out high monthly distributions. It is the engine that allows you to hit that salary replacement goal with a smaller total investment, acting as the aggressive income component of your passive income strategy. Let's go into the numbers where dreams meet math. Passive income must be $36,000 per year to replace a $3,000 monthly salary. Putting all your money in a standard savings account or basic growth fund could yield 1.5%, requiring $2.4 million. That's why most quit. Our 4 ETF blend can achieve a diversified blended yield of 5% to 7% while retaining growth. A $600,000 portfolio would give 6% blended yield. $600,000 seems like a lot, but it's a huge shortcut compared to $2.4 million. If you use more boosters and the yield tilts toward 8%, that number reduces to $450,000. The money shot is realizing that you don't need a multimillionaire to live a work-free life, just a specialized ETF portfolio. But how to get there faster? Acceleration strategy. Don't wait for $500,000 to start. Compounding starts immediately. The timescale shortens if you invest $1,000 a month in this 4 ETF blend and reinvest every dividend check. Early dividends may just buy a great meal. Some years later, they cover your car insurance. You get rent coverage a few years later. The magic happens when dividends buy additional shares, which produce more dividends. The snowball effect occurs. Someone who starts with nothing and stays disciplined for 15 years will frequently have a considerably higher salary than someone who waits 10 years to start with a significant sum. I won't sell you a fairy tale, so we must mention the significant risks. Not passive income immediately, hazardous. The biggest risks are dividend cuts and market crashes. If SCHD or VO has a terrible year, payouts may be decreased. If the market performs poorly, high-yield boosters like QYLD may experience NAV erosion, reducing their value over decades. Only choosing high-yield ETFs may hurt your long-term wealth. Therefore, we balance high-yielders with growth-heavy VOO and SCHD. A bad year might change your portfolio worth by 20% or 30%. Panicked selling in a poor market fails. You need stomach to endure red to get green. Smart investors transition on. When you're younger, like 20 or 30, focus on VOO and SCHD. You want development and compounding. As you near retirement or your exit date from the 9 to 5, you invest more in JPY and QYLD. This is how wealthy investors act. After building the mountain, they harvest the timber. The saplings aren't harvested for timber. By optimizing your allocation by age and goal proximity, you reduce risk and maximize money lifespan. Consider 3 real-life examples. Beginners with $0 should accumulate, not earn. You should expand 80% and earn 20%. Mid-level investors with $50,000 are seeing yield power. Your $50,000 may generate $250 a month. Not enough to quit, but enough to prove the machine works. Advanced investors with $300,000 are halfway there. Your dividends may cover your housing and food expenditures at this point, giving you psychological freedom most others never experience. Where are you on this spectrum? Are you starting the engine or nearing the finish? So the final verdict, can 4 ETFs replace your salary? Definitely, but with a huge asterisk. It takes time, discipline, and money. Simple, but difficult. $1,000 cannot become a monthly paycheck in a year. You can establish financial independence if you build this ETF portfolio and stick with it while others chase meme stocks or crypto movements. Make your time your own. Please contact me if you're ready to establish a passive income strategy. Comment below with your monthly income goal. $2,000, $5,000, or $10,000. In the next video, I'll analyze the figures and possibly determine your goals breakdown. Stay disciplined, invested, and focused on the long term. See you next time.